Good afternoon, everyone. I am Jacob Stein, and with me is Manya, Deva, Natan, and we are presenting to you today on international income and estate tax planning. We have over 100 people registered for today's webinar, which is very exciting, including quite a number of attorneys from other countries. So I guess good afternoon to everyone who is here in the United States, and perhaps good evening to those of you who are in Europe. Both Manya and myself do a lot of work in international income and estate planning, including tax planning. We represent a lot of clients who are foreigners and who are either doing business in the United States or investing in the United States. We represent foreigners who just happen to have assets in the United States, and that creates various estate tax issues and succession issues. So today's presentation is designed to address a lot of those issues. I think you will find that this presentation is very substantive, a lot of technical information, and certainly the materials that we have for you are very exhaustive. You do not yet have these materials. I find that when I provide the materials to the participants ahead of time, you guys start reading them, and instead of listening to us, you're reading, and it's hard to do both at the same time. So we will email the materials to everyone who participated in today's webinar at the conclusion of the presentation. You will also, at the conclusion of the presentation, receive your continuing education certificates, both for the continuing legal education and for the CPAs for your CPE. And with that, let's get started. So our first speaker will be Manya. Manya is an estate planning attorney with subspecialties in real estate, asset protection, and quite a bit of work on international estate planning. She represents some very notable clients. She's one of the best known estate planners in Southern California with a law degree from Stanford University, which is probably the best law school on the West Coast, perhaps in all of the US. The interesting thing about Manya is that she's not only highly intelligent and highly knowledgeable, she is just an awesome person. Clients love her, I love her, she is wonderful to work with, and I very highly recommend Manya to you. And she is going to start off today's presentation on the estate tax and estate planning aspects of representing international clients. So Manya, I'm gonna hand the presentation over to you. Please take it away.
All right. Jacob, thank you so much for the introduction and for the very kind introduction and for having me. I really appreciate it. And as Jacob mentioned, we are going to be getting into quite a bit of technical detail. That being said, I'm going to do my best to also make it interesting and provide case studies so that it gives real life examples for how this type of work is implemented. And I believe, so if you have any questions, put them into the chat box, and then at the end, we'll have a whole time for Q&A. So with that being said, as Jacob mentioned, I'm going to be focusing on estate planning for clients with international interests. This is defined very broadly. I like to say wherever people or assets move transnationally. So that could be, I have a number of clients that are foreigners and they're coming to the US either to invest or to buy vacation homes. And then plenty of US citizens that are buying vacation homes in other countries and or inheriting assets from other countries. So it's really whenever you have assets of any type, kind of in different countries, as well as family members or beneficiaries in different countries as well. So as some of you may know, California is a trust-based jurisdiction. This is different from many, if not most other countries in the world, meaning that for estate planning, the key document is a trust, not a will. If you go to most other countries, they will talk about a will as being the document that will dispose of your assets, meaning at your death, where is your property, where is your money, etc., going to go, to who will it pass. In California, the document that does that is a trust, not a will. And the reason for that has to do with what is referred to as the California probate minimum. So in California, if you own assets in California and the value of those assets is over $150,000, then even if you have a will, but you do not have a trust, the asset on the death of the property owner will be subject to probate. What that means is that you have to file a petition with the probate court and go, in LA County with the, 10 million plus people in the county. You can imagine that the court is rather backlogged and it takes a very long time. So if clients have assets internationally, let's say they have some assets in California and they have assets in foreign countries, or they're foreign investors, then the question is what type of document should be prepared? And the answer, of course, is always, it depends. The revocable trust document that we use for US citizens and permanent residents to avoid probate it's an excellent device and it works very well. However, if clients are non-resident aliens, that means if they are they don't live in the US full time, maybe they just have a vacation property here or an investment property, then the standard revocable trust that we, estate planning attorneys use ubiquitously in California is not going to work because it will be considered a foreign trust for tax purposes. So for estate planning attorneys in the US, this is a big issue that a lot of estate planning attorneys miss, right? That the revocable trust really is only going to work as we want it to work if the clients are either a US citizen or a permanent resident for estate tax purposes, and we're going to get more into how that is defined. So the test, the reason that the trust will be considered a foreign trust has to do with a test that we have here in the US for determining foreign versus domestic trusts. So a trust is going to be considered domestic if a US court can exercise primary supervision over the trust administration and US persons control all substantial decisions. All other trusts are foreign. This definition is super important when you're doing planning for clients with any international interests, because let's say, if people, let's say your client wants to name family members who are not in the US, immediately you're going to have, let me go back, you're going to have a problem with number 2 of the tests, that US persons control all of the substantial trust decisions. Even if, even if, let's say, an estate planning attorney knows, all right, I can't name the non-residents as, foreigners as trustees of the trust, if there are foreign beneficiaries, that also creates a problem if the beneficiaries have any decisions, have any decision-making authority. So for US-based estate planning, many times when we draft a trust, we'll give the beneficiaries the right to appoint or remove a trustee, or give them other decisions that would be considered a substantial trust decision, and therefore the trust would fail part 2 of the test and would be considered a foreign trust. So when doing planning in this arena, it's very important that the attorney know what is going to trigger this test, and if the trust is going to fail it and be considered a foreign trust. In terms of when should the grantor establish, when is it okay for them to establish a trust in the US? Usually I will link it to the point at which they have a social security number, meaning if they have come here and they don't have a social security number, it's probably not a good idea to do what we call a basic revocable trust. There are other planning strategies that you can use, which we will get into, but your basic probate avoidance trust is not going to work very well if they do not have a social security number. So again, to underscore what I was talking about with the court test, there are basic estate planning choices that if your clients are internet, if they're foreign clients, super important to look at these issues. That the successor trustee must be a US citizen or permanent resident. Because of this issue, the majority, when I draft documents for my international clients, many, many times I will use a professional fiduciary because of this issue, that they don't have family members in the US, that, they don't have family members here because they're from somewhere else. So professional fiduciaries can be a great resource for international clients. Another big issue that often gets missed is the naming of guardians for minor children. So most of my clients that are from other countries want to name guardians in the other country, which is completely fine. But if that is not spelled out in a document, and the main document for that would be a will here in the US, then they can run into trouble. So it is very important that that is spelled out clearly in the documents, especially when the children are to be relocated to another country. So a common question that gets asked is among estate planning attorneys is, well, I established a revocable trust for my client here in the US. They own property in Canada or the UK or Germany. How do I transfer title to that international asset into the name of their US-based revocable trust? And my answer always is you don't. You don't, you don't, you don't. You really, best practice is to have the applicable estate planning documents in each country where they have assets. The reason for this is that as I started the presentation with, the US is a trust-based country for the most part, and California in particular is a trust-based state. Most other countries are not like that, and trusts in other countries will often have adverse tax impacts or tax impacts that should at least be planned for that we don't have in the US. In the US, you can do what's called a basic revocable trust. It's a grantor trust that will avoid probate, but it does not have any tax impact during your lifetime. But that's not the case in most other countries. It's also no other country needs to accept the validity of a US-based legal document and vice versa. So I have many clients that have assets, in countries around the world, and my answer is always the same, that you want to have estate planning documents, that are unique to each country where you have assets. This is really important. I get this question many, many times. Even if the asset is just a bank account, you need to know how is title going to pass for that bank account. So it's I cannot stress the importance of this enough for clients who have assets in more than one jurisdiction. An important part of this planning is that the attorneys need to be communicating with one another. So if there's any other estate planning attorneys on this call, you'll know that many times when we draft a trust and even powers of attorney, the language will say that in essence, all previous documents are voided, and this is my final, will or whatever, power of attorney for healthcare or a durable power of attorney. If you have documents in different jurisdictions, obviously you don't want to be unintentionally voiding a document or creating any confusion, because many times in my experience, people will name different trustees, different executors in the different countries. So they might have a US-based trustee for their US assets, and then they have a UK-based executor for their UK assets. I actually am working with a client right now where that is the case. And you don't want to create any unnecessary confusion as to which documents should be used, etc. To give you a real world example of planning I did for a client who was a dual UK-US citizen. He had college-age children here in the US from a prior marriage, and then he was in a 10-year relationship with a woman actually from Australia who was an Australian citizen living in the UK, and they had a 2-year-old son together in the UK. He worked for a company in the UK, but he also ran a business in the US and came back and, spent his time split between the two locations. So with his planning, we did exactly what I talked about above. I worked with a UK attorney who prepared his UK will and a UK will for his life partner there. And then we did a trust here that is covering all of his US assets. And also, in that, I ended up naming a professional fiduciary to serve as the trustee for the very reason that he didn't have someone here to name who he trusted. And we put in specific language into both of the documents that, the trustee and the executor, meaning the US trustee and the UK executor, should work together to maximize the tax benefit when the time comes, because he did have a taxable estate. And as many of you may know, there can be significant, money that can be saved through planning when you have tax issues in multiple jurisdictions. So on that note, obviously for any foreign clients, you have to determine if they have a taxable estate, and estate taxes and income taxes are governed by different tests. So for estate tax planning, US citizens and permanent residents are treated the same for estate tax purposes, so that the determination of residence for estate tax is a subjective test. It's based on domicile, and a person is considered to be domiciled in the US for estate and gift tax purposes if he or she lives in the US and has no present intention of leaving. And I've put in the Treasury regulation there that you can look at. Every single case that I've come across that has been litigated on this issue is essentially when there is significant amount of money where the IRS would be getting a significant amount of taxes. The IRS says, look, there's not enough evidence that they intended to stay here. They made 5 trips in the last 2 years back to their home country, etc. And then the other side says, no, clearly there was enough evidence that they intended to remain here. So it is a very subjective test. What I tell my clients most of the time, if there's not a huge dollar value, huge tax at stake, most of the time it is not worth the IRS's time to fight it. But the times where there has been a lot of money, that is where it has been litigated, and that's the case law that we have on this issue. So just to remember, permanent residence, it's a subjective test in terms of whether or not the person is a resident for estate tax purposes. So why does this matter, right? This is actually, it's a huge deal, because if someone is a permanent resident for estate tax purposes, right now, under US law, he or she is eligible for the current estate tax exclusion of $11.2 million per individual. That means that they can leave, any person could leave up to $11.2 million free of any US gift and estate taxes to their heirs. However, that $11.2 million exclusion is going to apply to their worldwide assets. So their entire worldwide estate is going to be subject to the reach of that US estate tax. On the other hand, if someone is considered a non-resident alien, they're going to be taxed only on their US-based assets. US-based assets, there is a lot of detail to it in terms of what constitutes a US asset, but for example, real property, if it is owned by an individual, would be considered a US-based asset. Stock in a foreign corporation is not. But what a lot of people don't know is non-resident aliens only get a $60,000 total estate tax exclusion. So it goes without saying that the difference between 11.2 million and 60,000 is significant. Any assets over the $60,000 amount are subject to a 40% tax. This creates a huge issue for non-resident aliens who own property in the US. It also creates an opportunity to gift non-US situs assets to US beneficiaries free of estate tax. But a whole sort of niche of my practice is looking at the opportunities and helping clients plan to avoid this $60,000 estate tax exclusion issue. So for example, I had clients from Switzerland that wanted to buy a vacation home in Ojai. And if anyone is at all familiar with Southern California, you know that property here is expensive. And they were buying a house in Ojai for about $2.4 million and then putting another $500,000 into it. So we're at almost $3 million. If they had just purchased that property outright in their individual names, they would be looking at paying $3 million less the $60,000 exclusion in tax. Fortunately, there are ways that you can structure the purchase of property to avoid this. So what we did in their case was that we formed a corporation, a California-based corporation that was owned by a Swiss corporation, of which, and then that we took title in the name of the California corporation. So this is a way, it's a particular structure to avoid that asset being included in their U.S. estate, because it's not considered a U.S. situs asset. It's considered stock in a foreign corporation. It's sort of a nuanced detail, but it's highly relevant when if it's going to make the difference between paying 40% tax on almost $3 million versus not. Then another example of the type of structure that can be used to keep real property out of the estate of the non-resident alien is through the use of an irrevocable trust. And you can set up essentially have the foreign individual fund an irrevocable trust in a low tax jurisdiction. And then the trust would hold 100% of the ownership interest in a Delaware LLC, which would then invest in real estate. That is another structure in my, and you could use this for any, if clients had multiple investment properties. There's a lot that you can do. And again, it's going to keep it out of their estate. So that is another option when it comes to non-resident aliens who want to invest in property in the US. There are also planning opportunities and issues to be aware of when it comes to married couples. So US citizens are eligible for what is referred to as the unlimited marital deduction. That means that for taxable estates, when one spouse dies, right, and the surviving spouse is a US citizen, they aren't going to owe any tax, even if they have an otherwise taxable estate. Married couples can combine that $11.2 million exclusion for a total of $22.4 million exclusion, which means a married couple could potentially pass down up to $22.4 million without paying any estate or gift tax. If, however, the surviving spouse is not a US citizen, that unlimited marital deduction is not available. The assets would need to go into a Q-dot trust, a qualified domestic trust, upon the death of the first spouse to die. If that Q-dot is established, then the surviving spouse would have the equivalent of the unlimited marital deduction. But the trustee of the Q-dot must be a US citizen or a domestic corporation. A US domestic corporation. Portability, you may have heard of that. That is what allows for the combining of the estate tax exclusion of a married couple. So when we say an individual has $11.2 million of an estate tax exclusion that can be combined if they are married for $22.4 million, the way that happens is through portability. Portability is elected on the 706, which is the final tax return in the US. It's elected on the 706 to combine the remaining exclusion of the surviving spouse and the deceased spouse. This is only available for US citizens and permanent residents, not resident aliens. So again, we're back to being stuck with that $60,000 exclusion for non-resident aliens. There are also considerations when it comes to gifting. Any US person can gift up to $15,000 annually to another person, and married couples can combine this for a total of $30,000 that they could give. But gift splitting is not allowed if either spouse is not a US citizen or not a US domiciliary. And an unlimited amount can be gifted to a spouse who is a US citizen, whereas gifts to a non-US citizen spouse are offset by an increased annual exclusion, which is currently $152,000 indexed for inflation, meaning that's what a US citizen could gift to a non-US citizen. Okay. Now, of course, after all of that, one caveat to everything I have said, all of these regulations are going to be subject to applicable tax treaties. So the US has estate and gift tax treaties with 16 countries, or it may be embedded in the income tax treaty as with Canada. But it's important to know, one, what are the general rules and regulations with estate and gift tax for international clients? And then also, is there an applicable estate and gift tax treaty that would change that, what I just went through generally? So if there is an applicable estate and gift tax treaty with the country in question, it may slightly change what I just went through in terms of the applicable exclusions. So I'm going to give you one example, for Canada and the US situs assets are exempt from US estate tax if the worldwide assets are less than the unified estate tax credit. If the worldwide assets are beyond the exemption amount, then the treaty provides for a pro rata credit to provide taxation relief, and the credit is based on the percentage of the Canadian person's US assets over worldwide assets. If, for example, there was a $15 million estate and a $2 million US vacation home, they would be granted a reduction in estate tax payable equal to 20% of the ultimate estate tax that is due. This is only going to apply to the federal estate tax. It does not apply to US state estate taxes, and this is very important. In California, we do not have a state death tax or a state estate tax, but many states do. Washington, for example, Oregon, for example, and many people will move from California to Oregon or California to Washington. The client I mentioned before that was dual UK-US citizen, had a number of investment properties in Washington state. So that is something to also be aware of when you do this planning, when people may or may not be in California, and even if they are in California, they may have assets in another state which does have a estate tax. Another key thing when it comes to international planning is to be aware of any unforeseen tax traps that are based on the laws of the foreign jurisdiction. This is where I get into, you know, I always collaborate with an attorney in, you know, whatever other countries my clients have assets in. So Canada, for example, has a not well-known tax trap issue that if, per Canadian law, if many people, let's say they come from Canada to the US, they will become non-residents of Canada for tax purposes so that they're not getting killed on taxes in the US and Canada. However, if that person has been a non-resident of Canada for tax purposes for less than 5 years, establishing a revocable trust here could be treated as a deemed sale with negative tax implications. And a lot of people run into issues in other jurisdictions because they don't realize that a revocable trust, like I said before, is a see-through entity here in the US for tax purposes, right? But in another country, it may be considered a sale to a trust and thus generate capital gains. It's a huge issue that's often missed. And again, it just underscores the importance of collaborating with attorneys in whatever, you know, foreign countries your clients are own assets or are living in. So this is just to underscore what I touched on before, that when you do planning, you know, if clients have assets in other countries, they must have, you know, they should have documents unique to that jurisdiction. Now, there are such things that, you know, people often ask me that, you know, there is such thing as a universal will, and there's a number of countries that will accept a will if it's been certified by the local court. I consider getting documents unique to each jurisdiction a best practice. So could there, you know, could you get away with doing it differently with having one will? Yes. Would I recommend it? No. For, you know, for all of the reasons that I've said, I think it's important that you do have local counsel and that you do have local documents that are more quote unquote guaranteed to work in any country where you have assets. So that's just, it's super important, and it's something I lecture all of my clients about. Okay, so I think that is all for my part, and I know we're going to be taking questions afterward. Jacob, if you want to take it away.
Well, thank you so much, Manya. It was actually a great presentation. And while you were speaking, I was answering questions that were coming up. So okay, perhaps as I am speaking, you can answer my questions. Well, sure. Questions that come up while I'm speaking.
Sure.
So I am, 1 second please, I'm trying to set up screen sharing so I can share my PowerPoint slides. 1 second, folks. Here it is. Okay. So hopefully you can see the screen. This is now my slide. And my portion of the presentation for the remaining, I guess, 25 minutes is focused on international income tax planning. And income tax planning for NRAs is a bit different than estate tax planning for NRAs. So with estate tax planning, as Manya has explained, it's a very subjective test to determine residence. And depending on you know, the circumstances of the client, sometimes we may want our foreign client to be a U.S. resident for estate tax purposes to qualify for that $11 million deduction. Sometimes we do not want them to be a U.S. resident. It really depends on what is the value of the overall estate and where the assets are located, like how much of the wealth is in the United States and how much of the wealth is outside the United States. So there we have some play and we have some ability maybe to influence what is the whether the client is a resident or a non-resident. For income tax purposes, there is no subjective test. It's a very factual, objective, kind of numbers-driven test. And this test looks at a couple of things. One, it looks at whether someone is a U.S. citizen, and someone who is a U.S. citizen is automatically a U.S. tax resident for income tax purposes. So I'm sure we all know that. Someone who is a permanent resident of the United States is likewise a U.S. tax resident. So that would be a green card holder or a holder of some other type of a permanent visa, maybe like an EB-5, which is I think a conditional permanent residence visa. And then finally, there is the substantial presence test that looks at the number of days non-resident alien is present in the United States this year. And also there is sort of a trailing 3-year test with a weighted average formula that looks at how many days the foreigner is present. And either they are present for a certain number of days and they're a U.S. tax resident, or they're not. So really the only thing we can do for our foreign clients from an income tax standpoint is if we do not want them classified as U.S. taxpayers, just have them keep track of how many days each year they're present in the United States, periodically run calculations to see how close they're coming to meeting the substantial presence test, the 183-day test. And when they get close to it, tell them, to get out of the United States and not come here maybe until next year. So they don't exceed that threshold. And it's usually a threshold that most NRAs do not want to exceed. Why? Because as soon as they become classified as U.S. taxpayers, they're immediately taxed on their worldwide income, right? And that's sort of the huge distinction between NRAs and U.S. taxpayers. NRAs may be taxed on their U.S. sourced income. We'll discuss that in a second. U.S. taxpayers are taxed on worldwide income. And tomorrow when we have a colony on Mars, they're going to rename it and we will be taxed on universal income, right? Or galactic income, whatever they will call it. So we want to make sure our foreign clients remain NRAs for income tax purposes. So very mechanical test. So let's take a look now at income taxes that apply to NRAs. And really that will be determined based on the activities of the NRA for a non-resident alien in the United States. Are they investing in real estate? If they are investing in real estate, is it income producing or is it let's say, personal residence? Are they investing in a U.S. business? Do they have a bank account or an investment account in the United States? Maybe intellectual property? Are they entering into joint venture? Things of that nature. So let's go down the list. And as a reminder, for those of you perhaps who joined us a bit later, you will get a copy of these materials at the conclusion of the presentation. And also, if you did not get a chance to ask us questions during the presentation, either at the conclusion of the presentation, you're welcome to ask us questions, or shoot us an email. You have our contact information, both for myself and for Manya. You're always welcome to send us an email and ask us questions at any point in time. And this presentation, the way you are seeing it, meaning both video and audio content, will be available on our websites in the coming days. So if you'd like to have some of your colleagues view this, or your associates or what have you, you're welcome to it. It's available free of charge, and just view it at any time. All right, so let's talk about taxation of real estate. And taxation of real estate largely is governed by a body of law known as FIRPTA, Foreign Investment in Real Property Tax Act, thing of 1980 or so. And the FIRPTA effectively provides that all U.S. real estate on sale is subject to a withholding, meaning that if you have a foreigner who sells an interest in U.S. real estate, whether they own that real estate directly or through, let's say, a holding company of some sort, like a partnership or a corporation, the buyer of the real estate must withhold 15% of the sale price and remit that amount to the United States Treasury. The reason we have FIRPTA, one, it was sort of done to combat what was seen as the wave of Japanese takeover of U.S. real estate in the early 80s, late 70s. And more importantly, it was done because once a foreigner has sold U.S. real estate, they likely will take their sale proceeds and will never again be seen by the United States, meaning that next year, when the tax is due, there's no ability for the United States Treasury to collect the tax revenue. So the obligation is imposed on the buyer to withhold 15% of the sale price. Now note that this is not a withholding tax, meaning this is not the tax liability. This is simply the amount we are withholding and effectively escrowing it with the United States Treasury, right? Treasury is going to hold this money sort of in trust for the benefit of the seller, of the foreign seller of the U.S. real estate. And next year, the seller of the U.S. real estate will have to file a non-resident income tax return in the United States, calculate their gain from the sale of real estate, calculate their tax liability, apply the amount withheld as a direct credit, and pay the rest or get a refund of something that they have overpaid, right? So we're just escrowing the amount due. There are exceptions to this withholding amount. You can get a certificate from the Internal Revenue Service exempting the buyer from having to withhold. Problem is that very few clients come to us early enough to apply for this timely. It does take about 3 months maybe to get it. So very often, even our clients will end up with a withholding, and then next year they file a return and get the money refunded to them. So very quickly, very briefly on this side, I just kind of very quickly run through the different ownership structures for U.S. real estate ownership and advantages, disadvantages, and this is expanded much more in the detailed written materials that you will get. So if you have a foreigner who owns U.S. real estate directly, meaning direct ownership, that's bullet point number 2, you will have one level of tax on sale, right? You're an individual who's selling real estate, so it's subject to capital gain tax. But the downside is that you now must file an individual income tax return in the United States, and a lot of foreign investors do not want to do that. They're very privacy conscious. And also, if this foreigner happens to die, having owned U.S. real estate directly, that U.S. real estate is included in their U.S. estate with only $60,000 exemption. So direct ownership is something that we usually try to avoid, largely because of the estate tax. If we set up a U.S. corporation to own the real estate, meaning the foreigner owns a U.S. corporation, which in turn owns U.S. real estate, then the foreign individual does not have to file a U.S. income tax return. We do have a double tax, right? Because now we have a C corporation that owns, if let's say it's income producing real estate. The shares of the U.S. corporation will be included in the U.S. estate. And then whatever dividends the corporation pays out to the foreign owner will be subject to FDAP withholding, which we'll talk about on the next slide. If you have a foreigner own U.S. real estate through a foreign corporation, you usually will still have 2 levels of tax, the regular tax and then the branch profits tax, which is a little bit outside the scope of today's presentation because we have limited time. The advantage of the foreign corporation is that there is no U.S. tax return, no withholding, no estate tax. The structure that very frequently we will either recommend or see is actually the structure that Manya discussed earlier, where you have a foreign corporation on a U.S. corporation on the U.S. real estate, or sometimes it's U.S. business, same structure is used. The advantage often for using a foreign corp with a U.S. substructure is that with the foreign corporation owning assets directly in the U.S., you have the branch profits tax. And with the branch profits tax, you really have no control over that tax and when it hits you and how much it is. If you have a foreign corporation own a US sub, you have a lot more control over that tax and its timing, and we like that. The other possibility that we like a lot, especially for non-income producing assets, would be to hold the US assets in a foreign trust. And that may be a very good structure for a lot of clients. So very often it will be a foreign irrevocable trust that will hold a US LLC that's a disregarded entity, and then the real estate is in that LLC. This is a structure we will also frequently use when we have a client who comes to us and they already have US real estate in their name. They're worried about the US estate tax, and it presents a dilemma. If you already have a significant asset in the United States, how do you get it out of your client's name? Because if you gift that asset to whoever or to a trust, you now have a gift tax, a 40% gift tax off of the first dollar, right? Because for the gift tax, there is no exemption available to foreigners. So often what we will do is we will transfer the ownership of that US real estate into an LLC that is a disregarded entity, and then gift the interest in the LLC to an irrevocable trust. Sometimes it will be a US-based irrevocable trust, and sometimes an offshore irrevocable trust. And that magically avoids the gift tax. And if you'd like to know how that avoids the gift tax, ask me. And I will be happy to chat with you. Call me and I'll explain how that works. But that is the structure we use frequently. The category of income that foreigners are most often subject to, so this kind of the broadest category of income that applies to foreign investors, is known as FDAP income. FDAP stands for fixed determinable annual or periodic income, and this is largely passive income. Right? Passive income would mean things like interest, dividends, rents, royalties, commissions, salaries, bonuses, things of that nature. And if you Google it or look up one of the editorial tax sources, they will give you a long list of what FDAP income is. And largely this list is determined by case law. So often you need to either do some research or read some good editorial materials that have aggregated. But by and large, these are passive sources of income, like interest and dividends. And these types of income, if you're a foreigner, are subject to a flat tax of 30%. And this is what's known as a withholding tax. Withholding tax is a tax that is withheld at the time of payment. Meaning, let's say you are a foreign investor and you own shares of Microsoft here in the United States. Microsoft pays you $100 dividend. Because you're a foreigner, Microsoft is actually not allowed to give you the entire $100. They can only give you $70, and $30 Microsoft must send to the United States Treasury, right? So we know what the tax is, and the tax is withheld at the time of payment. So that's a withholding tax. And the foreigner has no obligations as far as tax filings or payments of any further taxes. We have determined and paid the tax at the time the foreigner received income, and their obligations, tax obligations to the United States, are concluded at that point in time. So that's a withholding tax. Most notably here is, well, two things you need to do. One is determine whether the type of income your client is receiving falls into the FDAP category. And if it does, is there a tax treaty out there that will reduce the withholding rate? The United States has 60-some, I think, income tax treaties, mostly with European countries, but a few other major trading partners like Japan, China, Australia, and the like. The tax treaties reduce the rate of withholding on FDAP income to a maximum of 15%. Right? So if a tax treaty applies, the FDAP withholding tax is 15% max, and sometimes it can be as low as 0. It depends on the type of income, and it depends on the tax treaty and what was negotiated in that particular tax treaty. In the years past, there were a lot of planning took around those tax treaties, where, for example, knowing that the United States has a very attractive tax treaty with the UK, and the UK then has an attractive tax treaty with some other country, income would be routed from the US to the UK, from the UK to another country, and from the US to the UK payment, it avoids the 30% withholding tax. Maybe it's reduced to, let's say, 5%. Well, there are provisions now in both US tax law, UK tax law, and most other countries that avoid what's called treaty shopping. And in order for the US-UK tax treaty to apply, there must be some substantial business operation, some legitimate business purpose for being in the UK. You can't simply set up a legal entity in the UK and take advantage of the lower withholding tax under the tax treaty. So what sort of income does not get taxed by the United States if you're a foreigner? So most notably, it's capital gains, right? So that's a huge exclusion for foreigners. Foreigners are not subject to tax on their US capital gains, with the exception of real estate, because gain on the sale of real estate is treated as effectively connected income. So it's taxed at a capital gain rate, but for withholding purposes and taxation purposes, it is effectively connected income. But other capital gains, like for example, let's say you have a foreign investor invest in US stocks or US business or US IP, and then they sell it at a profit, no tax, right? And that law was designed to encourage foreign investment in US capital assets. Income, interest income from bank deposits is not subject to tax if you're a foreigner. And we're literally talking about bank deposits, meaning that if a foreigner opens a bank account at Morgan Stanley, sorry, not a bank account, an investment account at Morgan Stanley, interest earnings from that account will be subject to tax. But interest earned from a savings and loan institution is not subject to tax. And then the big exemption where we do a lot of planning is the portfolio interest exemption. So oftentimes, if money is coming from overseas in the form of a loan, and then interest payments have to be repaid from the US to overseas, those interest payments are subject to the 30% withholding tax, unless the loan is structured as a portfolio interest loan. And if the loan is structured as the so-called portfolio interest loan, the interest paid overseas is not subject to tax. Not that it just avoids withholding, it's not subject to tax, it's not taxed. And you can read the materials that you guys have to figure out what is portfolio interest loan, or again, call me or email me. I'll be happy to discuss it with you. But this is a major planning possibility for a lot of foreign investment in the United States. And sometimes, if we are able to, we may even be able to disguise an equity investment as a portfolio interest investment and then avoid US taxation on the income generated from that US investment. Very quickly on the effectively connected income. So to the extent that a foreigner has a connection to a US traded business, income they generate in the United States is deemed to be income effectively connected to a traded business. And really what that means is that the foreigner will be subject to the same tax rules that everyone else in the United States is subject to. So if you have, for example, a foreign client who operates, I don't know, a hot dog stand in New York City, the way that hot dog stand will be taxed will be exactly the same as if a US taxpayer operated that hot dog stand. The only distinction is instead of, for example, Form 1040 being filed for that hot dog stand, or Form 1120, whatever is appropriate, it will be an NR form, non-resident form. But taxation will be determined pretty much exactly the same way. Very important to know in this connection is the so-called force of attraction rule, which provide that if you have a foreigner with US traded business income, other income that they have in the United States, as a general rule, will be automatically connected to their US traded business and taxed in much the same way. So it's force of attraction rule. So here it's important to know what sort of what sources of income your client has in the United States. Is any of it traded business? What are the other sources of income? Can we distinguish other sources of income from the US traded business and make sure that the force of attraction rule does not apply? So either that other income remains untaxed or subject to a much lower, let's say, FDAP withholding tax. And then very briefly, and I know I'm going fast, but we're trying to cover a lot of material in a 1 hour lunch. Pre-immigration tax planning. And over the past few years, this has been a huge source of work for us. We are seeing clients from all over the world moving to the United States, from China, from Russia, from Western Europe, South America, I mean, you name it, from everywhere. Very wealthy clients with a lot of money, huge estates, moving to the United States. And if these people fail to engage in tax planning proactively, what will happen is at some point, they become US taxpayers for income tax purposes, immediately subject to tax on worldwide income. And now their huge worldwide estate may also be subject to the US estate tax. Remember, that's more of a subjective test, so may be subject to the US estate tax. Before they move to the United States, before that fateful date, and we need to figure out when that is, when they become tax residents, if they're moving here, we can do a lot of tax planning to accomplish what? To increase basis of all of their assets to fair market value. So I'm doing this right now for a client who has about a $50 million real estate portfolio in the Czech Republic that they received some years ago from their parents. So there was somewhat of a basis increase, but that was a long time ago. The real estate has appreciated quite significantly since then. And if they simply move to the United States, they have whatever basis they have, but there's a lot of built-in gain already that was built in prior to them becoming US taxpayers. We can, prior to immigration, step up the tax basis of all of the Czech real estate to its current fair market value, and the client can sell the real estate the day after moving to the US, and there's no tax. But that requires some pre-planning. If the client has offshore entities, especially operating businesses, we need to strip out accumulated earnings and profits, hugely important. If they have losses, they will be recognizing from overseas assets, overseas operations. We want to need to defer loss recognition until they become US taxpayers. If they have income they're recognizing, let's recognize it today before they move to the United States. And then from an estate tax standpoint, we want to make sure that their assets will not be subject to the US estate. So maybe move their offshore assets into offshore irrevocable trust and out of their US estate. So we just recently concluded an engagement for a client that had an estate of about $500 million. And imagine if they moved to the United States without any planning, they would immediately have a $500 million taxable estate in the United States. And then we can do our, idjits and cuprits and this and that, and how much realistically can we reduce a $500 million estate. But before they move to the United States, there is so much we can do, right? Because today they're not yet subject to US taxation. The world is our oyster. We do need to coordinate this work with foreign lawyers and foreign accountants to make sure that whatever we are doing for US tax planning purposes is okay, let's say, under French law or German law, whatever country we're working with. But a lot can be done. So I apologize for rushing through the presentation. I know we answered a lot of questions as I was talking and as Manya was speaking as well. But if you have more questions that are coming up, again, please feel free to use the Q&A portal or send an email directly to me or send an email directly to Manya. You can do it now. You can do it in a week. You can do it in a year and just say, Jacob, I've attended your presentation and I have a question. Can you help me? I'm always happy to help. And I know that Manya is always happy to help as well. As a reminder, you will get all your continuing education certificates in the coming days. You will get emailed a copy of these materials. And this presentation in audio and video form that you have seen and heard will be made available on our websites. So you're welcome to download it at any time, re-listen to it or share it with your colleagues. And we do have lots more webinars coming up on various topics, so please stay tuned for our emails. We will let you know when the next webinar is coming. I'm Jacob Stein, and with me was Manya. We thank you for listening to us. We appreciate you attending this presentation, and I hope to catch you next time. Have a great day. Bye-bye.